see one more push up right into that level. And then the question is, can it break that? And that's going to be the tougher scenario for Bitcoin to get through that 25.5. Yeah, I mean, I think as of now, the markets are kind of taking it with a grain of salt. They don't seem to be too positive or too negative on it. I think they're taking it the right way, which is that, it is more spending, but at the same time, it's probably not that much compared to multiple rate hikes. Like a 75 basis point rate hike by the Fed probably basically negates that, if you ask me.
Yeah.
So I think the markets are kind of in that position of saying, okay, it's good for certain stocks, alternate energy, solar stocks, stuff like that. But for the most part, they're all focused on that data at this point, right? We have that 2 months, like you said, before the next Fed meeting. It's all about the CPI number this week. And I think the markets probably are going to chop going into that. No, I'm still in that same camp. I mean, in the very minimum, I think 25.5, I still have about an 80% probability that we'll get to that level. And if we just take a look at the chart, you can see we've just been meandering in this beautiful kind of consolidation phase, right? So it is a bearish channel. I mean, let's be clear on that, but that doesn't mean we can't go up a little bit. And if you look now, the high end of the channel is crossing right at that pink trend line, which is actually that 25.5 pivot low from the Terra Luna collapse. So it makes a lot of sense to me that we should see one more push up right into that level. And then the question is, can it break that? And that's going to be the tougher scenario for Bitcoin to get through that 25.5. And then if we, again, and I think we'll look at Ethereum in a little bit, but Ethereum, like you said, is bouncing around this level of resistance. But I do think there's a chance that you could get up to that next one right around 2,000 if Bitcoin can make that next move up. So I think for the most part, I'm still neutral to positive. I think that you have a Fed that's on hold. You're likely going to see a reduction in or inflation numbers are going to come down. We've seen commodities really come down substantially over the last couple months. You have to think that's going to filter through to the CPI data this week. And I think that gives the market that ability to have a little bit more risk on before we see maybe some downside in the next few months. I think it would create a big sell-off. I think you get a risk-off trade in both the equity markets as well as the crypto markets. And again, the idea is we already got a stronger than expected jobs number. If you couple that with higher inflation again, the markets are going to say, oh my goodness, the Fed has to do 75 basis points in September. And who knows if they can even stop going into the midterm elections at that rate.
Right.
So I would be very surprised if that happened. But if it did happen, you're looking at a big sell-off, especially because the equity markets and even Bitcoin have rallied over the last couple months, especially since the last Fed meeting when the Fed was much more dovish, right?
Right.
So that alone kind of is building in the fact the markets have been building in this idea that those CPI numbers are coming down. If that doesn't happen, watch out below, right? So it's not like inflation's negative or down to zero, but at least we're not seeing higher numbers. And I agree with you, the lagging indicator of jobs. I mean, I'm sure you've talked about this, but like every day I see a new big mega company reporting new layoffs. And so even though we had a strong jobs number, at some point, all these companies laying off people, it's going to filter through. My guess is the next jobs number, we start to see that. And that's one more signal that the Fed probably has to take a slowing approach to raising rates. And I did see this stat recently about how many car loans are being falling behind on their payments. And I think you're starting to see that. And what's so scary about this scenario is that it's not only a slowing economy, but the car loan aspect, what that tells us is that it's not necessarily the slowing economy yet that's impacting, it's inflation. So you throw a slowing economy, like people losing jobs with inflation, and the idea is that, I mean, you're going to see a lot of defaults out there. Yeah, I mean, I still have to think that, inflation not coming down would be a very, very nasty wound to the market, because it just tells you that, again, the Fed has made it very clear that they have to get inflation under control, and they're willing to push the economy into a recession. So the market's hoping that inflation starts coming down, and that eases the Fed's pressure to kind of continue to lift rates. If that doesn't happen, I mean, you have to think the Fed is more than willing to push us into a steep recession to get that, and the market would not like that one bit.
Yeah.
That's still what I'm looking at, right? Is that you have this period where the idea is maybe the Fed can generate a soft landing, and that's giving these asset prices. We're seeing the stock market having quite a monster rally off of its recent lows. Bitcoin hasn't had a monster move, but if you look at Ethereum's had a huge move off of the lows as well. So I mean, you know, the idea is the soft landing keeps us from going into recession. It keeps the Fed from really tightening too much more. But if you get this scenario, and this is what I think is going to happen, is I think you're going to see an economy that slips into a recession, then a worse recession, and the Fed, again, the inability initially to save the markets is by printing money like they have in past recessions is going to be very, very problematic, and it's likely going to trigger a domino effect into a worse recession. Now, at some point during this worst recession, probably in 2023, you're going to see the Fed say, oh my goodness, unemployment is now at 10%. You know, with a recession, you usually see a reduction in inflation. Maybe inflation's come back to 4%, and they're going to say 10% unemployment, we have to start printing again, or at least lowering interest rates to stimulate growth and get some of these people off of unemployment. And that's going to be, to me, that is where you see the pivot in Bitcoin from a risk on or risk on asset to actually becoming more like that gold and starting to take off in those printing money periods. Yeah, I mean, I can look at the 10-year here, and I think the 10-year is really interesting to take note of. Let me bring that up for you guys and to take a look. So here's your 10-year, and what we have seen is that the 10-year has backed off. And what I like to tell people is that the 10-year yield is very much a forecaster, right? So initially the Fed was going to have to be so aggressive with all these 75 basis point hikes. So prior to those hikes, you really saw the 10-year yield surging to the upside. Now, interestingly enough, let me show you this here chart. Let's go to a different 10-year yield chart here that I have. But basically, if we look at that, and I'm not getting the right one up, but bottom line is there was a key trend line hit right here, where if we stretch this out, you can see that this trend line, the yields when we got to about 3.5% tagged that line, and you can see what's happened. I mean, it was you couldn't have nailed the better top in the yields, but notice what's happened since then. We've now seen the Fed kind of being a little bit more dovish, even in spite of the hot jobs number. And I think, again, yields are likely starting to think about maybe the chance of a recession. And we all should remember that the bond market is known as the smartest of the markets. That big money from the bond market usually is a better forecaster than short-term stock market moves. So I think that, again, I wouldn't be surprised, and I have it forecast that we could see in the next 6 months a move down on the 10-year yield to basically close to 2%. Before it starts to stabilize and maybe turn back up. And the only way that's going to happen is if we slip into a steep recession where people start speculating that we now maybe will see the Fed loosen up on policy and maybe not be so aggressive. So I think that for the most part, you know, that's a tricky question. I'm kind of leaning towards the concept that Bitcoin still is that risk on, risk off asset at this point. But I do think eventually you see that pivot point where you get Bitcoin to kind of be more of a dramatic mover to the upside during periods of turmoil. And again, I think that is coupled with the Fed starting to print again at some point in the distant future. In terms of trading with the 10-year, it's right now it's not. It could change, obviously, but right now I'm not seeing that. Yeah, so I actually agree with that. It's just the timing of it, right? So I'm in the position of looking at it and saying, all right, the Fed, there's no way the Fed will start printing at this stage or even in the next, let's say, 6 months, because they can't do it with inflation numbers as high as they are. But once inflation numbers do come down to an elevated level, but not extreme level, again, 4%, which is kind of where I see them coming back to, and then you do get the economy to swing into a recession that's bad enough, I absolutely agree that the Fed will start printing again. It's their only playbook that they have left to do to stimulate, and the markets expect it. Investors, I mean, what's amazing about the price action recently, just yesterday, or I should say Friday and today, we saw the meme stocks running again like crazy, like it was 2021, which tells you that small retail money is thinking that just like in the COVID crisis, the Fed is going to come out, print, and get us all back to all-time highs in a matter of months. I think that's a fake out. I think the Fed, again, there's no way the Fed can print with the pressure it's putting on. And just think about politically, like you have a midterm election, the Fed can't start printing before that. I mean, that would be catastrophic for the Democrats. So Again, I agree that the printing will start again. It's just probably at some point in the next year to year and a half versus in the near term. That's I actually like it. I mean, it's one step. I don't think it changes the fact that we're in a bear market. Greed and fear really rule the markets, and right now people are fearful if the economy tanks more, if it's risk off, people will sell regardless, and probably institutions will still be very hesitant to buy into Bitcoin until we have a firm framework of kind of regulation out there from the government. But I do think, again, like I love seeing this stuff since I'm a long-term Bitcoin bull, because it's just kind of one more piece of the puzzle that's going into kind of the frame that will be a positive long-term for crypto. It's the adoption, right? I mean, for me as a Bitcoin long-term bull, my biggest fear is that it becomes obsolete, that institutions never get involved, that you don't have that money, that people put pension funds in it and all these things. And BlackRock getting involved with Coinbase, to me, kind of is just a great thing in the long term. Doesn't affect short-term price. Long-term, it's really good. Good question. So short term, I'm going to play the conservative side, and I think Bitcoin is the play here. Ethereum's already over 100% off of its lows, and I think, again, Ethereum has that higher beta where in market bounces, it's going to do more, but then in market bear markets, it's going to lose a lot more as well. And because I still think we have that leg down, I think if you had to choose one, you want Bitcoin because, again, it has the stability, it has relative stability to Ethereum. Now, longer term, that's the better question, right? I think that, again, you'd probably want some exposure in both, so you cover both bases. You have the use case of Ethereum and the Ethereum network, and then kind of the digital gold where a lot of institutional money will flow into the Bitcoin, Bitcoin investments. So I think in longer term, I like both of them. I think I would generally say to people to be careful with other cryptocurrencies because, we see, if you look back 2 years ago, a lot of the ones that were in the top 20 are no longer in the top 20 of market cap. So there are ones that are replacing, like Solana wasn't around that long ago. Avalanche wasn't around that long ago. And so there's still a jockeying for what the third and the fourth and the fifth will be, as if you're looking at the blue chips. So I think if you're looking out long term, you don't know yet, but I would stick with Ethereum and Bitcoin as your investments for the longer term right now. Definitely with Bitcoin, and I would say that. I mean, longer term, yes. And one of the things to remember is even when I was bearish at 68,000 or so, it's not that I don't love the concept. Going back to when I first learned about Bitcoin in 2012, it was when the Fed was printing just after the 2009 crisis, and it just makes so much sense to have a currency or some sort of store of value that's not US dollars, not euros, not yen, all these currencies that can be printed ad nauseum by central banks. And so I love the concept. It's just the growing pains as a trader. You start to recognize these charts, and it doesn't make sense to hold at 69,000 or 68,000 when you see it going to 20 or sub 20. Might as well sell there and re-enter at a much better entry. Then you buy a lot more, and then you get ready for the next run. It certainly is very tricky for kind of a retail investor because, again, picking tops and bottoms is extremely hard. It's taken me, I've been a trader for 2 decades now, and it certainly didn't come to me in the first decade. It came to me more in the second one. Now, having said that, I do think that the retail crowd can start to at least look for certain signs that make them feel uncomfortable. And just like you dollar cost average in, there's nothing wrong with dollar cost averaging out in a way where you take a little bit off the table. And what I would say to the retail crowd is, look for signs of mass hysteria. And when you see that, when you see everyone, when you go into the bagel store or the pizza place and you got the guy behind the counter telling you he just got into Dogecoin or he just got in, those are signals that as a trader, you can't get excited by, you actually need to get fearful by. And so again, I'm not saying you necessarily want to say, oh, I'm going to dump my whole position, but what's wrong with taking 25% off when you see those signs and then potentially rebuying at a lower level? So I think dollar cost averaging in is great. And I also think taking a little bit off the table, like I say to all the traders that I trade with, no one went broke taking a profit, right? Worst case, you might not have made as much, but at least you locked some in.